Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. Me, Ryan Huang, and we are looking at the latest quarterly macroeconomic review from the MAS, where they have flagged that the raft of tariffs announced by US President Donald Trump and the uncertainty over the extent of damage they will cause across the global economy will depress in Singapore economic and wage growth. So that's going to be something to watch out for in terms of where things go in 2025, especially with the US being Singapore's second largest market, accounting for 11% of domestic exports in 2024. So how worried should we be and where are things going? Let's check in now with Brian Lee. He is the economist at Maybank Securities. Brian, good morning. How have you been doing?
Good, Ryan. Thanks for having me.
Yeah, great to have you on because it's all about the economy when we talk about tariffs, and there is a lot of talking going on right now with all the trade partners that the US is working with. And this is where tariffs have been flagged as a potential issue, causing potentially a demand shock to the Singapore economy. That's the warning from the MAS, and they have maintained their earlier growth forecast, 0 to 2%, but warned that prolonged trade conflicts could pose further downside risks to the country. Brian, what's your assessment of where things are right now? How worried should we be about a growth slowdown?
Yeah, so I think a growth slowdown is in the card. Our forecast is for the economy to grow by relatively muted 2.1% this year, and that compares to the exceptional 4.4% growth print that we saw in 2024. Basically, the global economy is now going through a trade conflict, as the MAS mentioned, right? On April the 2nd, the US imposed customized reciprocal tariffs for each of its trading partners, right? Some of which were very, very high rates, much higher than 10%, going up to even 50, 70%, and so on and so forth. And China has been hit by over 100% of tariffs. Even Singapore has been hit by the baseline 10% rate. Right. So how does this filter through the economy? Basically, the 10% tariffs are going to hit our exporters. They're going to hit our manufacturing and trade-related services industries. Right, but they also hit us indirectly through a decline in global demand, because our trading partners will be hit by, in many cases, even higher tariffs than us. Right. So in the US, there will be higher import costs, and as a result, it will likely affect domestic demand. And in China, which has been hit by the highest tariff rate, Chinese exporters will see lower external demand. In fact, many of them are already cancelling their shipments to the US. And ultimately, this is going to reverberate through the supply chain, right, in Asia, right? Singapore has a key role as a supplier of intermediate goods and services to the world, and also to China, right? And so we'll feel the impact on that front. On top of that, there's also not just the tariffs, but also uncertainty, right? Uncertainty is has rapidly increased over the rapidly evolving trade policy, over the rapidly evolving US administration's economic policies, right? And also whether there will be retaliation from its trading partners, how long will the tariffs last, what magnitude will they be in July after the 90-day pause, and so on and so forth. And all this, I think, is not good for global consumption. It's not good for global business investment. And also, it may result in tighter global financial conditions as well. So, again, we'll feel the shock on that front, not just through, our goods sector, but also possibly in our services sector. For instance, our financial sector is very plugged into the global and regional economies. And, with tighter financial conditions, we are going to see possibly lower, an impact on credit intermediation, and also an impact on markets, so that, in other words, net fees and commissions for banks.
Yeah, Brian, a couple of things to unpack here. Of course, you pointed out there might be indirect spillovers because of Singapore's role in the global supply chain, especially regionally. And then, of course, there is this ongoing overhang of uncertainty with the tariff situation. Where is the momentum right now? How worried should we be about a potential technical recession, or some are even saying a full-blown recession? What do we need to look out for?
So technical recession is definitely in the cards. Technical recession is basically just defined as 2 consecutive quarters of negative sequential growth, right? Basically, the first quarter, we think that GDP growth will likely be somewhere around 3.6%. That's slightly lower than the 3.8% that MTI penciled in. And, what this implies is that in the second quarter, as long as growth comes in below 2.5%, then we have a technical recession, right? And this is definitely within the range of possibilities that we incorporate in our 2.1% full-year forecast, right? Full-blown recession is different, right? That goes beyond a technical recession, right? And we see that, there are some factors that can help Singapore avoid a full-blown recession, right? First thing, in the second quarter, there's been a 90-day pause in the reciprocal tariffs for countries other than China. And, we could see as a result some degree of continuation of front-loading, right, of orders and shipments. Yeah, so that could benefit our manufacturing sector, or that could cushion our manufacturing sector at the least. And, at the same time, domestically, we do have some things going on, like, for instance, a robust pipeline of construction projects. So currently, we are not penciling in a full-blown recession. We think that Singapore will have a growth slowdown, right, but not a full-blown recession, right? Okay. But of course, what are the risks, right? What will need to happen for a full-blown recession to manifest? Of course, we don't know how this trade conflict between US and China will manifest. We don't know how it will escalate, whether it will go beyond tariffs. And also, we don't know what are the rates of the revised reciprocal tariffs, whether they will be much higher than the 10% during the 90-day pause. And when they kick in the second half, we could see really our manufacturing sector contract, and as a result, GDP growth go down to about 1% thereabouts, right? And on top of that, of course, we need to assess whether there will be disorderly corrections in global financial markets as a result of the shocks, which could result in a deeper than expected global recession, as IMF has also pointed out. So all these, of course, with Singapore very not immune to global trends, I think it's dependent on all these factors. Yeah, definitely
a lot of caution in the air. And you kind of pointed out a couple of bright spots to look out for. Construction is one of them, the strong pipeline of projects. I'm wondering, where does the AI boom come in for Singapore? Because you've got MAS flagging that demand for AI-driven stuff will still provide some underlying support to the global semiconductor industry. How much will Singapore benefit on that front?
So Singapore it's true that global semiconductor sales have been doing not too badly, I think, in the early part of the year. And as a result, if you look at our non-oil domestic exports, the electronic sector is still leading in terms of trends. However, the AI boom, right, this is capital spending, right? And in a global economy with lots of uncertainty on the trade front and also how tariffs will increase costs in the supply chain, there is a possibility that basically AI spending will be affected, right? And as a result, the AI boom may be possibly disrupted or at least paused. And I think on top of that, last year we did see, I think Singapore has benefited from the AI boom, right? We saw that last year, and we saw that in the early part of this year. However, the kind of semiconductor product mix that we produce is not. It would be more, I think, weighted towards the mature node chips, right, and also certain memory chips, right. So we don't really produce the cutting edge node, advanced node like 3 nanometer, 4 nanometer kind of chips that Taiwan produces, or the kind of high bandwidth memory chips that are used for AI training models that Korea produces, right. So we have been a beneficiary, but not as big of a beneficiary as the North Asian economies. And on top of that, I would say that the AI boom could actually be disrupted by this ongoing global situation that we are in. Yeah.
All right, lots to watch out for with all the tariff tensions and global trade wars going on. And of course, Singapore not immune to the possible shocks, and we should be looking out for possibly a technical recession, not quite yet a full-blown recession. All that with the help of Brian Lee this morning. He is the economist for Maybank Securities. Brian, thanks so much for your time and insights.
Thanks, Ryan.
All right, great chatting with you. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.